All right, sweet. Well, we will jump into it. You know what the topic is, housing and personal finance. So I want to talk about a couple of things today. How do we get here? Why does it matter? And specifically, I wanted to cover these agenda items. First of all, I wanted to start with this idea of a housing expense ratio. What is it? Why does it matter? And then I want to dive into defining the problem a little bit more. So in order to define the problem, we'll start off with the economics of income, talk briefly about historical demographics, and then look at some supply and demand, which in the housing market really correlates to inventory and prices. Then I'm going to talk a little bit more about why does this matter, and then finally get to the good part, some of the solutions. So how I hope that I am doing my part to help, and then also some of the really exciting solutions that we have coming forth on the regional level, and also some of the ones that will be necessary in a more systemic way. I also want to, if I have time, provide one example of an interesting solution. It will not be the catch-all solution, but the conversation could be an interesting one in terms of where this particular solution could go. Okay, so kicking things off, let's get into it with this idea of housing expense ratios. So in order to start the conversation about housing, we have to have some of the foundations of personal finance in place to make sure that we're on the same page, because I say this a lot, but we live in a capitalist society that just throws us to the wolves in terms of financial education. We don't get a class in school. We don't tend to have conversations. Money is a taboo topic. And so it turns out that for most of us, we don't have a common vernacular when it comes to this stuff. So the idea of a housing expense ratio is pretty basic. It is just a generalized rule in financial education that says you should try to have your housing expense be below 30% of your gross income. That's it. Just housing expense, general guideline, 30% of your gross income or less. Now, Jansen Tidmore from the Jeffco EDC, who's always involved in these conversations, when he and I talk about it, he's like, why is this, a gross income? Why isn't it based off of net? And to be honest, I think because it is a very general rule and most people don't even know what their net income actually is. Plus, there's all sorts of factors like how much am I contributing to a 401k and things like that that can skew it. And so this is not the end all be all, but it turns out that this is a very good starting place when it comes to figuring out how much should I pay for housing. Because the reason I have this jar full of money here is because that analogy where we have a jar when it comes to our finances, and you have to fill the jar with the big rocks first, and then all the small stuff will fill around the big rocks, right? Well, in the financial world, housing is our big rock. There are a few other big ones that we'll talk about more later on, but housing is certainly one of the big ones. So this is where this ratio comes into play. Talking about the problem, there's kind of two sides to this. For one, it is really hard to stay below 30% housing expense ratio in our area. I'm going to be talking a little bit more about why that's the case and providing a few specific examples. But there is a second issue at play here, which is, as I mentioned it before, we were not taught this stuff to begin with. So when we are making our personal financial decisions, we're largely flying by the seat of our pants, right? And at the end of the day, money is emotional. And we know Kahneman Tversky wrote this huge book on behavioral economics. It's called Thinking Fast and Slow. We know that as human beings, we use mental shortcuts. They call them heuristics to make decisions. And it allows us to make decisions much more quickly without having to analyze every single piece of information in front of us to come to the, optimal conclusion. But it is important when we're teaching people how to empower themselves to make those decisions. It's important to recognize that we make those decisions with that emotionality in mind. Most people learn personal finances at the end of the day, I think, through making mistakes and correcting them over time. And the fact of the matter is that the margin for error in these regards is simply thinner than it has ever been. We're going to talk a little bit more about that data as well. Okay, defining the problem a little bit further, I wanted to talk briefly about what we find in Jefferson County specifically. So if we were to look at, and this is just one position that I chose, but if we were to look at a Jeffco public schools educator that went ahead and got their master's degree. They went to extra schooling to go ahead and achieve that extra level of certification. We see that the maximum starting salary that that educator could have is just under $70,000. So that equates to a monthly gross income of $5,750, meaning if we take 30% of that, we have $1,725 maximum to spend on housing. Let's look at an affordable condo, affordable in quotes, of course, priced at $350,000. Well, on the monthly basis, once we add in HOA fees, that is going to be $2,762 a month. So that is a $1,000 a month gap for a educator in our community that has gone above and beyond the standard level of requirement, standard level of education needed to get that master's degree. So that means that our teachers can afford to live in the community that they serve. Now, I use this particular example for a couple of reasons. One is the fact that I wanted to preface the fact that the housing problem is a community and business problem. It's not a personal problem because when people can't live within the community that they work in, businesses suffer in terms of attraction and retention of talent. And we're seeing this now in our communities. It's not just in our educational systems, but I thought that this example was relevant. And the second thing that I wanted to bring up with this particular example is the concept of how do we actually look at a population's housing expenses? Because some people might ask, like, well, like, love it or hate it, which I hope most of us hate it. Teachers don't get paid a whole lot. So, like, how does that compare to the rest of the population? Like, how do we look at that? And I will talk briefly about this later on. How do we compare broad scale population dynamics in terms of housing where people have lots of different incomes? But for right now, I want to get a little bit deeper into the problem. Just wanted to hint that that would be coming. In Jeffco in particular, there is a 20,000 unit gap of rentals and mortgages only between $1,250 a month to $3,500 a month. That is an annual salary of about $50K to $150K, depending on the household size. So this work, by the way, before I move on too much further, was really defined by the work of the Jeffco Affordable Housing Advocacy Steering Committee. It was also based on a countywide housing needs assessment that was also run in collaboration with that group. So, in order to stay under 3,500 for a mortgage, a home must be under 550,000. Just wanted to put that context out there. And as of July, and this was a week or two ago, so it's constantly updating. But as of a week or two ago, there were 124 single family homes and 372 multifamily units for sale in Jeffco that were under that 550K mark. That's 2.5% of the current need in this price range. So this is, again, kind of the foundation where we're starting in terms of the problem here in Jeffco. So given that, let's talk about the population comparison that I just mentioned on the last slide. How do we look at broad scale populations? This is really something that is known as area median income. So AMI for short. And these terminologies get very technical. So, at the end of the day, for us as normal people going about our lives, we don't think in terms of AMIs. That's why you can see that these are monthly numbers that I have up on the screen here. But just to give some context, when we're talking about AMI, the area median income is basically that unit where we're comparing, like, where is the income for an individual within a broader community. So if my income is at 100% AMI, that means I am exactly at the median income for the area that I live in. If I'm at 120, I'm slightly above. If I'm at 60% AMI, then, I'm at 60% of what the median income is for the area that I live in. The reason that this is worth bringing up, I suppose, is because, again, we are focused really on this 20,000 unit gap right now in Jefferson County. And so this is going to be, there's lots of components of the problem, but I just want to define this a little bit further because this is something that Jefferson County is working on quite a bit right now. This would be an area median income of somewhere around 60% to 120% of our area median income here in Jefferson County. So the reason that that's important or worth bringing up is we'll get to it a little bit more, but basically because when we think about kind of some of the options out there for housing, there are government incentivized programs that are able to cover the lower end of the AMI spectrum. And Jefferson County specifically found that the biggest gap was here in this range of between, let's call it 60 to 120% AMI, where all of a sudden, people in those ranges didn't have places that they could step up into after perhaps they had bought their first home. Talk about that a little bit more later on as well, but I just wanted to bring up that context before we get into some of the historical data here. And so the question, of course, is how did we get here? And my answer is it's not the lattes and avocado toast that is driving our younger folks in the population to not be able to buy homes. I laugh about this sometimes because and there is a real component to it. Like I'll give this quote actually that I just pulled from searching some social media for some ideas surrounding the housing situation that we're in. And when you go to social media and see what people are saying out there, here's a quote that I found. It's the instant gratification generation. They change cars every 3 years, phones every year, eat out every day, 3 times a day, party nonstop. They look at what people achieved over a lifetime, but they want it now in their 30s. There are a lot of views and perceptions out there that I would like to bring some data in to challenge because I do not think that is representative of the story of how we got here. And that story, I think, is really important for what we are going to do moving forward. Again, that idea even of stepping stone houses and how we have kind of not developed the infrastructure in order to create that stepping stone pathway. It's all a component of the conversation. So what I want to draw your attention to in this particular slide is these 2 charts. I made them pretty small, so I'm just going to describe them just to give you the point. These both come from the Fed, the Federal Reserve of St. Louis. They track a lot of this data over time. And the first one that you'll see on the top is the personal savings rate. This goes back to 1960, and you can see that our personal savings rate in the 60s all the way through basically the 80s was above 10%. 10% of income was going towards savings and investments of some sort. And we see this trend beginning where that savings rate has gone down over time. We see there's a crazy spike here during the pandemic in 2020. There's lots of government stimulus introduced. Not going to go into the dynamics there, although it is very interesting to analyze that in particular. But we see that after this time frame, we are now back to the sort of the trend that we were on previously, and savings rates are down to around 3.5%. There's a lot more to say here, but for now, the point is that savings rates are low, and many people go, yeah, well, savings rates are low because everybody's buying those lattes and avocado toast. Is that true? Well, we can look at the second graph, again from the Fed, and see the real disposable personal income chart. Go back to 1980, and what we see is that if we look at the inflation-adjusted value of what we were spending on discretionary purchases in 1980, inflation adjusts to $18,460, as opposed to in 2022, we see that number at $16,080. So the amount inflation adjusted of disposable income that we are spending is actually less. It's not growing. And the question is, what's going on? Like, let's look at the broader picture. And I think that this gives us a much better perspective of the comparison between 1980 and 2022. What we see here is a table with the cost of tuition, fees, room and board shown first. Each one of the numbers from 1980 is inflation adjusted outside of the parentheses, and we have the unadjusted value in the parentheses. So in 1980, the cost of tuition, fees, room and board was $3,100 compared to $28,000 now. Well, let's inflation adjust that. In 1980, that would have been today's $11,000. So we can see that that $28,000 is over double where we were. This doesn't even bring in the intermediary layer of student loans and student debt. The starting salary with a bachelor's degree in 1980, inflation adjusted was $53K compared to $54K today. So our starting salaries with a bachelor's degree, despite the cost of tuition more than doubling, our starting salary with a bachelor's degree is basically the same as it was in 1980. Same thing we find for median family income, 74K, inflation adjusted in 1980, 74K today. We also know that we have far more two income households today than we did in 1980. Median home price, inflation adjusted 227,000 in 1980 as opposed to 442,000 today. So almost doubled. And again, for rent, we can see the same trend is occurring. The median rent in 1980 was an inflation adjusted $863 compared to $1,388 today. Notice that this chart doesn't even include the third of our big three factors, our big three rocks in our personal financial jars, right? There's, of course, housing, which we're talking about. There's student debt, and there's childcare. Those three big factors have completely changed, and we're in a different economic environment and world than we were at the time. I want to take this just a little bit deeper, and I'm gonna go through this pretty quickly because I don't want to spend too much time on it because I feel like at this point we're beating the same point over and over again. But basically, if I was to take the unadjusted numbers from 1980, we can see that our home prices, our median home prices at the time, are about 3 times the salary at the time, as opposed to 6 times the salary today. But there's a little bit more analysis to do because when we think about home buying, there are more layers than just the purchase price of the house. So what this would mean in 1980 is a down payment of $12,800. So a little over half of somebody's annual income, as opposed to $88,400 for a down payment on that same house today. That's over the entire annual income that person has. We can also see that the rate in the 80s was higher than it is today. Even though we're facing 7% rates right now, we have a 13% rate. But what does that do to the monthly payment and to the expense ratio? Well, we can see that the monthly payment was $596. So in terms of an expense ratio, that was about 34% of the median salary at that time. Now, notice that number is a little bit higher than 30%, the golden rule of personal finance. There are a lot of reasons for that, but I think that 2 of the main reasons are because people don't always follow that rule. They stretch a little bit beyond it. And then secondly, because when we're thinking about median salaries, we're including the entire population that's working, as opposed to when we're thinking about just our home monthly payments. There are less people who are actually making those mortgage payments. And so presumably those people tend to have a higher income. That would even out that expense ratio a little bit more. But what that translates to in today's world is a 42% expense ratio. And you can see I had the same, if everything was the same as in the 80s down here, meaning if the home price was only 3 times the salary, and if we had a 13% rate instead of a 7% rate, where would we land? Well, we would still land at that 34% housing ratio. So we are in a different economic world when it comes to housing. And I want to expand a little bit more on how we got here, because I think this story is interesting. Basically, this is a chart going back. You can see the generations listed here. I want to direct your attention first to this circle in the middle of the chart. What you'll see is that there is a large population decline there. Now, we've had those previously, but this one is especially important for a couple of reasons. The main one being that if we zoom forward 33 years from this date, and the reason that we're going to zoom forward 33 years is because the average age of a first-time homebuyer is 33 years old, although that's starting to get older nowadays. But the average age of a first-time homebuyer is 33 years old. So we zoom forward 33 years, and we are at 2006. And what happens in 2006? Well, we have, and by the way, I'm going to kind of skip past this. I might come back to that other arrow. The only point there is just to show that where we are today, we do have population continuing to increase for a little while. But I wanted to skip forward to this slide because basically when we zoom forward 33 years, remember, we saw that same drop in the population. And this, you can see, I actually screenshotted this directly from a webinar with this guy, Barry Habib, a housing expert, a mortgage rate expert, won the Crystal Ball Awards multiple times, and a great source of information about what's going on in the housing market. But basically what happened is when we look 33 years forward, it's no longer births underlying each generation that we're looking at. Instead, we're looking at household growth. That would be the corresponding data point to the births by generation. And what we see there is those people 33 years old now are going, they're forming these new households. And we see this same corresponding drop in these purple blue bars here for household growth, meaning that that population decline that we saw back in 1973, 74, in 2006, that is meaning that we have less households coming into the market and purchasing. At the same time, look at these bars in orange. These are annual completions. Builders are building heavily at that time, and there's lots of other stuff happening as well, right? The mortgage industry is going wild. It's unregulated. They're handing out mortgages to anybody who has a pulse, whether or not they will be able to afford them and pay them off over the long term. And what we see happen during this time frame is kind of as we expect. We see the Great Recession. We have this housing crash. And, looking forward into the data from 2009, 10, 11, all the way into the modern day, we see that these annual completions have remained low. Even in 2017 through 20, when the the household growth numbers are beginning to go up, we're still seeing these annual completions at a low rate. And the answer, the reason why is because builders got scared from the 2008 recession, along with a number of other factors. So we have been underbuilding for quite a while now, which contributes to the fact that we have extremely limited inventory. Now, there's more reasons than just that we don't have enough inventory overall. It is also important to note that it's not just the builders for why we have low inventory. I think that this is a point that just has to be brought up, although it will make some people go a little, and get a little mad about it, is the moment that buyers buy their first house, that tends to be the moment when they want to stop the building of other houses around them. They want to stop other development, right? And, I think that there's a lot of reasons why that might be the case, including the fact that, hey, if we can stop development, then that might, or, maybe artificially elevate my own home price. But there are a lot of problems with artificially reducing supply and therefore elevating prices, including the most prescient one for these homeowners that want to stop other development is, well, when the price of our homes go up, all of a sudden our tax bills also go up. And we have seen that be a big concern for homeowners in the last couple of years, even putting in kind of emergency measures through our legislature to stop some of it. So it is important to at least note that. A couple of other components to the problem I mentioned, this lack of stepping stone options, diversity of housing out there. And, if you think about it, like what are we going to start with when it comes to well, we're probably going to start with something that is more towards a multifamily development. Maybe we try to buy a condo for our first home. Maybe we buy a townhome. And if we don't have options in those regards, then it's going to be hard to get that first stepping stone into the housing market, right? And that deals a lot with this secondary bullet point that I have here, which deals with permitting and regulations. That is an item of concern. It is very challenging to build condos, and I'll talk a little bit more about that later on as well. One more thing that I want to mention is the landlord landscape. We have seen landlords transition from, more mom and pop style landlords renting out a small number of houses to a landscape where we have many more corporate owners and big companies that are managing rentals in the modern age. And I think that it's at least worth bringing that up as a component of the problem. And then the last piece is, as we mentioned, in terms of our personal economics, there are other big rocks in our jars. It is not just our housing expense ratio. It is also childcare. It is also student debt load and a number of other factors as well. The point here and why this matters is because the housing burden is a business and community burden. On the personal level, of course, like we don't get to learn foundational personal finance, and this affects all of us. But in our communities, this is something that is coming forth as, important. It matters for teachers and baristas and bartenders and the people that are serving us in the communities that we love, that we're able to live in, that we love to go out and recreate in, pay for these services. They need to be able to live in those communities also for us to be able to support the activities that we love within those communities. We'll talk a little bit more about that in just a moment when I get to the regional and systemic solutions. But before we get there, I want to talk more about how I'm approaching this problem in general. So what I want to say in this front is I run the free foundational education and coaching program here at On Tap. So I work with members one-on-one. I connect with local companies and do these larger presentations, which is a way for members or for employees to get to know me and then book more one-on-one sessions where they can get into some of the personalized individual coaching. But I do want to show a little bit of an example of this. So let's see, before we move on, if you all will be able to see my example within this. Miranda, can you see our spreadsheet here?
Yes, you can.
Awesome. Okay, perfect. So this spreadsheet is the main one of the main tools that I like to use to basically get a handle on our personal finances. A lot of people will think of this as being like a budget, and it kind of is. But really, the goal for me is that this is called a cash flow system because the idea is budgets get us so stuck thinking about like restricting our expenses and not spending more money and don't go over budget. And, basically what happens is we end up being stuck in the past with budgets. We get to the end of the month and we review our expenses and spend time looking at it. And we're like, oh, shoot, I missed my budget again. What am I going to do next month? And so this tool, I like to use this as a way to fulfill a psychological principle that is really important for change, which is we have to begin to live by a vision of the future rather than by the memory of the past. And so that's the point of this conscious cash flow system, is to be able to simply give us a view of the playing field and to be able to therefore say, like, don't spend too much time on this, but what would happen if I moved and, my housing expense went down to $1,000 instead of X, Y, or Z? Oh, this is what happens. Okay, cool. Now I've seen the playing field. I didn't actually do the thing, but that means that I don't have to go forward thinking like, oh, I think I know what my problem is. It's that my grocery bill is too high. And so for 3 months, I restrict myself and I get my grocery bill down by $100 a month. And I found out that it didn't make any difference at all. Right. So that's the quick background to how we use this particular spreadsheet. But what I want to show you within this is showing an example person. This person has 80K of income. So we've broken it down by their gross monthly income per month, also their net. I like to not separate out 401k when we're talking about net. I just am taking taxes out on that front because we'll get to 401k later on, even though it's pre versus post tax. We're getting into more personal finance side of things. The point here is that this person makes 85K a year. And what you'll see here is the first category is their living expenses. Now you'll see here that it's recommended that you get your living expenses to between 50 to 60% of your take home pay. Again, our our jars only have so much space in them. And so if we overflow them, then or if we simply fill up one part of our jars too much, then it's not going to leave room for all of the other things that we want to do with our financial lives. So that's the reason that it's recommended you get to between 50 to 60% of take home pay. Do people do that immediately? No. If this person who's at 85%, sometimes it takes years. Sometimes if you're young and you can expect your income to increase over time, you can allow time to bring this number down for you naturally. But at 85%, we know that this person is going to be stressed in their financial life because with that big of a chunk of our jars taken up just by our living expenses, it doesn't leave a lot for other stuff, including our future selves. I want to note that the housing expense ratio here is right here. It's 35% for this person at $2,200 a month. Now you'll see that they have all of their other, monthly expenses listed. I like to add the most miscellaneous category, which adds 15% for things that you forgot because we will forget them. And then I want to also, highlight that this person has 4% going towards investments. So $200 a month going towards their 401k. They're not putting anything towards savings at the moment. And lastly, you'll find the category of the guilt-free number. And this is the number that says, hey, you know what? saving is great, but also like we do want to live for today also. Like, what do I get to do, just for me, for fun? And this is that number. This is like, I don't need to feel guilty about buying myself a latte X number of times per month because I already knew how much I have allocated towards my guilt free spending. And I've already covered my future by putting stuff towards investments and savings. This is what I get to spend. You'll notice that this person has 11% in their guilt-free spending number. So currently they're spending about $575 a month on whatever they want, but this person doesn't have any savings, right? So this was an example of somebody that I was working with. I'm going to flip the page to show what ended up happening. Now, not everybody changes like this, but for this particular person, they decided, you know what, like that $2,200 a month that I'm spending on rent, that's killing me. And you're right, like this 35% number, and this took a long time to get to. It's an emotional thing. But basically what they said is, you know what? I'm going to get a roommate. I'm going to do it. And in this case, they actually got their roommate to pay slightly more than half. They took the smaller room. And it worked out great for this person. There are some components to doing that you gotta deal with. You got to do tenant selection. You gotta, figure out how to get along with a roommate. There are just components of it that come up. But at the same time, this person reduced their housing expense down to $1,000 a month, which is a 17% housing expense ratio. Now, this sounds crazy, but there are multiple people I work with who are using this tactic who it does what I'm about to show you within the rest of their finances, which is his living expense ratio is down to 58%. That means that we have so much more space for the other categories when we go to split the check of our income, as we call it. Could we want to split the check between myself, my future self, and all of these different entities? Also, a little bit goes to the government, right? And so, in this case, this person actually increased their investments. They were at 4% only. They're at 16% now on their investments. They added savings goals. They weren't saving anything. Now they're at 10% on savings and they are at 16% on their guilt-free percentage. $827 a month instead of $575 a month to spend on whatever he wanted while he's feeling guilty because he didn't have savings or investments, right? So this changes the entire financial game for this person to have simply affordable housing. The one thing there changed the entire financial picture. I find that to be a really powerful example. All right, moving on. I wanted to show you that. I also wanted to highlight the fact that here at On Tap, the other thing that we do is we have a mortgage program for our employees that basically allows employees to buy their mortgage at rates that are insane. The reason that On Tap specifically does that is obviously because we want to attract and retain really high quality talent. And so that is important for us. But it's not just within On Tap itself. We also use a employee perk program where we partner up with companies in our local area. And the goal is for me to be able to do financial education presentations that help to reduce the amount of stress and anxiety that employees might feel surrounding their financial situation, which increases productivity and retention. And along with that program, we also offer various perks when somebody goes to get a mortgage. Now, those perks always depend on somebody's situation, as you might imagine. There's low and no credit options even for some folks to begin building credit and then eventually work their way up to a house. For somebody who's ready to go buy a house immediately, they might have other advantages like a free appraisal, X, Y, and Z. But I just wanted to highlight those couple of things. And the reason that I really wanted to do that is because obviously I do this work through On Tap Credit Union. So I do want to take a brief moment to at least give the quick background into credit unions. Basically, what a lot of people don't know about credit unions is that we are set up as a not-for-profit structure. You'll see at the bottom of this page, there's a line that comes from the credit union world, not for profit, not for charity, but for service. Another common one that we'll see out there is people helping people. So basically, as a not-for-profit organization, the goal for a credit union is for all of our profits to go back to our members. And of course, that happens from high yields on deposits and low rates on loans. But we recognize that nobody ever built a wealthy life by saving 0.5% on an auto loan, right? Like, we love that. It's great to save some money there. But the ways in which we're able to do that is by the longer term ongoing, healthy, positive, productive conversations and planning about our money, our housing, and what we're going to do in those regards. So that is why we as On Tap Credit Union are out in the community, putting this back out there. Do we have amazing products? Of course. And I am not going to tell you about them at all because that's not the point of this. I want to get on to the rest of the conversation about housing. However, because we're able to put this type of information out there in the community, I will say if you find any of this stuff that I'm talking about valuable, go check us out and consider opening a free account and see if you like it. If you don't love your bank right now, I bet you'll like what we're doing. And you can book some coaching sessions with me while you're at it too. I wanted to give a little bit more of a brief background into where I come to the conversation from, but I don't want to spend too much time on this because I want to talk more about the regional and systemic solutions that we're seeing out there. The thing that I wanted to tell you in terms of my background is two things. One is that I come to this conversation from spending 9 years as a high school math teacher. And one of the things that I learned as a math teacher is that, at the end of the day, brilliance and creativity cannot be measured. Like they express themselves in a myriad of different forms. And they cannot be necessarily measured completely by going and, taking just the SAT. There is a wide diversity of thought out there, and all of it is very useful in understanding and helping to build and grow our society using that diversity of thought. And so the reason that I bring that up is just because one of the tenets that I take with me from education is really when having conversations like this, I want to always be expanding perspectives. I think that if I and my students can step into somebody else's shoes and can see a situation from different angles, honestly, that is the greatest adaptability that's going to help us to thrive in the modern world. And so I want to encourage us to do the same thing when it comes to housing. And the last thing that I wanted to note about my background here is you'll see under the on tap symbol there is a symbol for the Jeffco Advocacy Network, which I am a part of, and I'm going to tell you a little bit more about on the next slide. But basically, I want to encourage you to check out our website and to learn more about the conversation that we are having on the ground level within the Jeffco Advocacy Network itself. Okay, I want to talk about a few regional solutions here. And the first point has a star next to it because it actually has a number of different components to it. So in Jefferson County, I actually think we are a exemplar for working positively towards a resolution of some of these issues. And so I wanted to put this Jeffco blueprint, quotes, on here as a way to talk about a lot of different important organizations. Now, there's one that is driving it in particular. So I'll talk about them in just a moment, thanks to them. But we have local governments, we have county commissioners, we have planning commissions, we have steering committees all working on these issues. We have the Foothills Regional Housing making a huge impact, along with a number of other local housing authorities. So just one example of a location in very near Old Town Arvada that has a very interesting housing solution is called the Avi. And I know about it partially because I do some work over there with some of the residents, but it is one that is definitely worth checking out a little bit further. It's a great example of a housing development that is done in a very modern way and the way that we're seeing it done nowadays. Okay. I also wanted to come back to, again, on this idea of the Jeffco blueprint, back to a few other organizations. So we have the Colorado Gives Foundation, which I will also come back to again when I talk about the Jeffco Advocacy Network. But basically, I wanted to highlight the work that the Colorado Gives Foundation is doing because it is quite extensive. And I think a lot of people don't realize how integral of a role they've played. This Jeffco blueprint idea is really something that stems from the work of the Colorado Gives Foundation. In terms of what they're trying to do with this blueprint is simply recognize that in Jefferson County, we have a lot of different entities that are all working on solutions towards this housing problem. And oftentimes we're just like, whoop, we're just missing each other in some of the work that we're doing. So this blueprint is a way for all of those entities to begin to align around this common mission within Jefferson County. And it is a very cool framework. Certainly wanted to be able to highlight that one. Also, under this umbrella of everything going on in Jeffco, also have to highlight that there are a number of different local chambers working on the issue. The Arvada Chamber of Commerce actually has this. It is a business housing advocate workbook. Um, and I'll talk in a moment. It's been super cool to check this out. Just wanted to highlight that that's out there and that business owners can use it to help to figure out how can we help our employees to find good housing solutions in our area. Wanted to talk about a few of the incentive funds out there. There's Prop 123. There is the Innovative Housing Incentive Program. And there is the Colorado Gives Bring It Home Fund. All three of these are working towards the issue. I won't go into too many of the dynamics of them, but I just wanted to put them out there that there are funds available for some of this really innovative work in the housing space. And there's also a lot of legislation going on. So you can see here that I've highlighted a few pieces of legislation. There are so many that are worth talking about. The reason that I wanted to just highlight a few of these is because for one, this SB 232, this is the Senate bill from 2022, number 232. It defined workforce housing as basically that 60 to, well, really 80 to 120% AMI, area median income range that we were talking about previously. Now, I also within this wanted to highlight something that is interesting because this bill called that particular range, they called it workforce housing. And it's interesting, as we've been having this conversation, you may have noticed that I haven't been using the terms affordable housing very often. I don't think it's descriptive. I think that it begins to, it can cover a number of different solutions to the issue. And yet it begins to form into only one perception within our minds, which is oftentimes inaccurate. Just to give an example there, sometimes what people think about when they hear affordable housing is back to these Section 8 housing vouchers, which as a program was not as successful as perhaps we had hoped that it would be. In the modern day, that has really transitioned more over into Section 42, LIHTC type housing, which had a very much more modern vision. There is some really cool stuff going on within that realm. And yet also, the reason that I wanted to come back to this 232 defining that 80% to 120% range as being workforce housing is because that presents a problem also. Thankfully, Kathy Smith, one of my mentors in the Golden area and friends, has pointed out the fact that basically it's like, what the heck? Are you saying that anybody that's below 80% of the 80 area median income, like, isn't a part of the workforce? They're not working, they're not contributing to our communities. And of course, that's not the case, right? And so really, I wanted to just bring that up as a point that we are going to have to continue to really think about the language and the terminology that we're using when we're facing this problem. Wanted to come back to this House Bill 24106. This actually did not pass, but it will be coming back around again. It is about the right to remedy construction defects. And the reason this is important is because this helps with developing multifamily solutions. We're seeing in the insurance world out there, and honestly, Florida and condos are a case study for us that if builders cannot remedy construction defects, if they can be held liable, then we get less condos built. This is an intertangled, mess of policy and regulation here. But basically, the point is, how are we able to offer more of these stepping stone options like condos and townhomes without the red tape, perhaps, that makes it more expensive to begin with? And I think that there's some interesting solutions there that could be possible. There's a few more that I mentioned or that I listed here. 1434 expands the affordable housing tax credit. Some of the ones that I didn't list is House Bill 1152 is about ADUs. Those could be one component of the solution, but they will not solve everything. No one thing is going to solve this entire solution for us. 1313 allows for more density in transit-oriented corridors. I'm going to talk a little bit more about that on the systemic solutions. And 1316 provides a middle-income housing tax credit. So these are just some of the many bills that we are working on a state level. this is exciting stuff. We are in a very cool time and there's a lot of hope. And I hope that that comes through in some of these solutions because sometimes, those first couple of slides where we see the state of the economy, it's like, whoa, like, what are we going to do? And I think that there have been a number of really positive solutions that are coming forth. Some systemic solutions. I think that we have to begin to do some form of foundational financial education. I think that houses are one of the components where we should certainly be doing that. I think people should graduate from high school just understanding that a housing expense ratio is a generalized rule that I should be at least thinking about as my first calculation when I go to look at houses. And yet it's not. So that's my personal mission is to provide free foundational financial education to everybody in Jefferson, Denver, Larimer, and Boulder counties. Um, if you would help me in that regard, that would be fantastic. The second point that I want to put in place, we've talked about it a little bit, is we have to begin to address some of the permitting and regulation issues, especially surrounding condos, multifamily units, townhomes, things like that. One more systemic solution that's worth bringing up is this idea of additional dwelling units, ADUs, and modular homes. I think there's a lot of exciting work in these regards. And I'll tell a little bit more of a story of ADUs in a bit if it is worthwhile. I'm going to ask for if there's any questions and things like that first, and then I can always tell that story later on. Um, Transit-oriented corridors. So this you heard is something that is coming up more often in Colorado. Basically, the idea here is that if we can create more density within a corridor that has transit, meaning there's a light rail, there's a bus, system running through there, then basically more people, that density will allow more people to use those transit corridors, and we can create more efficiency within our communities through that pathway. The problem here that is beginning to come up is oftentimes these transit oriented corridors tend to be on the highway, right? So if somebody is driving on the highway on 25 and they happen to be in this transit oriented corridor, they might look around and think, oh, like we're just trying to cram density in every nook and cranny of our entire metro area slash state. When the reality of the matter is that that density may be oriented around that transit corridor, and you go just a couple of blocks beyond, and people you can find, your single family homes that you're looking for, again, it's all still there. One of the components that comes up. So that's all I'll say about that. And then lastly, I think I mentioned this language and terminology for perspective. I mentioned this idea of perspective expansion. My goal is always to figure out what are the perspectives of other people in these regards and how can I bring that into some of these conversations. So speaking of that, I wanted to tell the story, the perspective of a friend of mine who is actually developing these. These are these really cool modular homes. They are actually shipping container homes. So they take old shipping containers and they form them into these dwelling units. And I think this is so cool. But the reason, to be honest, that I wanted to tell this story is not because I think that this is going to be the housing solution that we will arrive at. Um, I think that there's certainly some purchase to be had with some of these innovative solutions and with the idea of can we develop ADUs more on that as a whole in general in terms of like, I feel like a lot of people would like the idea of offsetting some of their rent if they could rent out an ADU that they had. But no, the reason that I really wanted to talk more about this particular story is because this is a person who is a principal architect um, in a partnership with a wife who works at a high-paying tech company, and they are in a very similar situation to the situation that I'm in, along with my wife, where both of us have decided that we feel like it would be economically irresponsible for us to have kids in the current situation. And so, at the moment, like maybe we'll get to a time and a place where we think that it's possible. But I wanted to share that perspective because I think really when we're thinking about some of these broader conversations, like it's not just the housing that got us there. It's the economics as a whole. But housing is the big one. It is the starting place in this regard. Um, in my friend's situation, they actually do own, they have a condo. The HOA changes so much. And we've seen recently because of insurance claims or, insurance costs rising that you can't trust an HOA to stay stable. So wanted to bring that into the conversation here. Okay, I want to pause. I want to see if there's any questions that can be answered. I'm also going to go ahead and flip the slides here. If anybody wants to have a follow-up conversation, this link or this QR code on the left will book an appointment with me. I have a free guide to personal finance on the right. If you know folks that would benefit from that, please share it. I'll continue to do more resources in that regard, but I want to just take a quick pause, see if anybody had any questions that could be addressed or answered, and then we'll go from there. Let's see. Kathy, you got anything for me?
I think you did a great job.
Thank you.
Nice summary.
Awesome. Appreciate it. Well, you have been a fantastic mentor in these regards for me. So thank you. Okay, cool. Well then, we got a couple of minutes, so I am going to take take that time to go ahead and share one more quick story. This kind of idea that that crosses my mind, and it goes back to this point again. And that is, it's my own story. And this is not going to be the solution, but I do want to at least mention this because I do think that it could be part of the solution. So for me and my wife, we eventually were able to buy our first house, and it has been quite a journey. I have learned a lot from it. But the big thing that I wanted to say about that is the way that we were able to do it ultimately was through this idea of house hacking. And that's the idea of, can I offset some of the mortgage or the housing expense that I'm paying by renting out a part of my house, or maybe I have a separate ADU, additional dwelling unit, that I could rent out to offset that mortgage. And so, that was ultimately what we did. There are other components that come into play. You become a landlord when you're renting something. You have to learn what goes into being a landlord, what the pros and cons are. You have to incorporate phantom costs that come up in housing of repairs and maintenance that many people don't think about as being a monthly expense that I should add on top, even, just because the roof needs to be replaced for $20,000 once every 10 years or whatever the case is. Um, and so the point here is that, there is more involved to becoming a landlord. But in my case, it has been a extremely successful pathway to homeownership and to offsetting costs. And so the thing that I see as potentially being like one tiny component of the solution is, how do we encourage more folks, first of all, get to a place where permitting and regulations allow for ADUs? We're at a place where that is in motion. We have had some bills that allow for more opportunity in these regards, but the cost of building them still remains high. And my question is, like, goodness, what would it look like to create basically a movement, even like a financial freedom type of movement, where people begin recognizing, like, whoa, I could build something, like this, an ADU. Maybe it's a garage unit ADU on top of my garage, and rent out a room and offset the mortgage. Basically, what that does is it creates more density in some regards. You have somebody living on your property with you. And what I have found is many people go, oh, I don't know about that. But what I've found is, like, goodness, once you learn kind of how to do the thing, how to be a landlord, it creates an incredible community. Like, I have had incredible experiences with my tenants that share our property with us. We say hi to them every morning. It creates like I don't know. There's something to be had there. And I feel like there's something where, goodness, if we could figure out a way, modular ADUs or something like that, where, the permits and the regulations are all there, to where we could begin to have single family homeowners begin offsetting their mortgages by having tenants on their property. I'm like, goodness, I think that that would be one way to create a movement of some sorts. And of course, there's a lot more involved in that. I don't necessarily think that this is a like going to become the solution, right? But I do think that just as a thought experiment, an idea. What would it take to get people interested in that? Well, I think we're in different economic times and people are thinking about their cash flow and their budgets a lot more closely. And I think that there's something to be had there. So that's my own little personal anecdote of ways in which, I think there's some creative thinking to be had and solutions out there. Oh, you know what I forgot to talk about, Kathy, which I'm mad at myself for, and I'll throw in a pitch very briefly for is totally skipped over the last part of the slide, which is I want to encourage everybody to please go check out the Jeffco Advocacy Network. You can find us at jeffcoadvocacynetwork.org. Basically, this is a group, a coalition of citizens and engaged civic leaders that are working towards solutions to our housing crisis. And we're doing that through on the ground advocacy. The biggest thing that I would ask you to do is not only check out our network or our webpage, but go to our resource center. You'll find that there are a number of different articles, reports and fact sheets, and webinars that we link to down here. And the other thing is there's a part where we can share your housing story. So you can place, just go ahead and post your story. We are collecting more and more stories because we want to be sharing them more within our communities. We want more people to understand where we're at, what the stories of the people in our communities, and where we can go from here. So please go check us out, share your housing story. And other than that, reach out. I'm excited to hear from you all and continue this conversation. That's all I have for you. Sweet. We're at 1 hour. See you all next time.